Are there any canaries in the coal mine that you or anyone, either from that experience in '08 or going forward, really pay attention to say, okay, this could be something to monitor?
So let's take a very practical example from today. So AI, I'm sure folks are asking AI in a bubble, certainly towards the end of 2025. And so there are certainly some things that were indicative of bubble-like conditions. So we had a general purpose technology, AI, that's being adopted, and there's incredible capital expenditures. Folks are spending a lot of money to try to figure out how to monetize it. We also have had a massive transformation in the way capital is allocated. If you think about it, in 1996, Matthew, there were more than 8,000 publicly listed U.S. companies. Today, that number is closer to 4,000. Over that same period, back 2 decades ago, there were only about 1,900 U.S. companies working with a private equity partner. Today, there's more than 13,000. And we also think about the private credit market. It's quadrupled in the last decade. So the way that capital is now allocated has transformed considerably. You also have a great deal of credit creation, which again, isn't a good or bad thing. You have a deregulatory environment that's likely coming, and you have a Federal Reserve that is lowering interest rates or being more accommodative. I look at those things, and that is fuel for risk assets. I think next year might be another decent year for risk taking. Now, let me give you 4 reasons why I don't think AI is in a bubble. So you'll remember back in the TMT bubble days, growth companies' earnings were actually contracting. Today, they're expanding. The second is the duration and the magnitude of the capital expenditure cycle back in the 90s was much longer and much bigger than today. So meaning in the 90s, more money was spent on fiber optic cable and all that stuff than what has been spent on AI. My point here is that the AI spending is only just beginning. We're in the early stages. So that's 2. The third one is around profitability. You'll remember back in the TMT days, the companies that performed the best had the highest multiples, didn't earn any money. There was no earnings to be had. It was clicks and eyeballs. Today, investors are hyper-focused on profitability. So just recently in the earnings season, when Meta announced a greater kind of capital expenditures and Oracle decided they were going to go to the debt markets, investors weren't clear on what the path to profitability was for those investments, and those stocks got punished. When you're asking about what is that pinprick for the bubble, historically, it's been the Fed raising rates. In 88, 89, the Fed was raising rates. It ultimately led to the savings and loan crisis and the 1990 recession. In 1999 and 2000, the Fed was raising rates at the time from 4.75% to 6.5%. And in March of 2000, the TMT bubble burst. As we start 2026, the Fed is cutting rates and they have stopped quantitative tightening. They've been more accommodative. So for those 4 reasons, I don't think we're in a bubble environment. I think some of the conditions are there. But for me, what I would be looking for is Fed tightening monetary policy or an unexpected acceleration in interest rates, similar to what you highlighted in 2022. That will be the mechanism that potentially hurts what has been a strong bull market rally since October of 2022.